Hi there, welcome to Nepi Invest, and welcome to my pursuit of high quality companies that are not on the ASX. This was inspired by Sensei, who asked me to look at high quality companies that are listed on the London Stock Exchange and the Tokyo Stock Exchange. I've looked at a few of those companies thus far, including Keyence, AstraZeneca, and Halma. Now I'm doing a video or recording a video on Tokyo Electron. What is it? A semiconductor manufacturer, and they also do other stuff as well. This is a website. It took ages for me to log into this website, by the way. Ages. I went to their Wikipedia page. Japanese electronics and semiconductor company headquartered in Tokyo, founded in 1963, best known as supplier of equipment to fabricate integrated circuits, flat panel displays, and photovoltaic cells, PV cells. Okay. Largest manufacturer of IC and FPD production equipment in 2011, listed on the Nikkei 225, had a market cap of 114.6 billion US dollars. Well, that has changed. Now, this is a particular screener I did use for this particular exercise. It's my rule of 10 screener, looking at revenue growth, return on invested capital, and operating margins. And I'm looking at the last 5 years, and I want all these three to be above 10%. So revenue growth above 10%, return on invested capital, and operating margin average, 5-year average, to be above 10%, only for companies with a market cap above $100 million and excluding a few sectors, including mining. And 124 companies popped up on the TSC, which might be a record. Not even NASDAQ or the New York Stock Exchange had this many companies popping up, 124. And this is listed by market cap. And the biggest company in Japan is Keyence Corporation, then Chugai Pharmaceuticals, and then coming in number 3, we have Tokyo Electron, ticker code 8035. That is something interesting, that the ticker codes in or on the TSC are by numbers. So Tokyo Electron. So let's have a look. What I'm going to do is we'll have a look at why or how this company, or why this company might be considered high quality, just by having a look at their financials. So have a look at the financial history, have a look at the overview, and then we'll have a look at the chart. Okay, so this is Tokyo Electron Fiscal AI website or site. I won't go through the company overview and exactly what they do. According to this, they were founded in 1951, which was a little bit different than Wikipedia. They said 1963. There you go. So a little bit of difference there. A little bit of difference between Wiki. Oh, there was a predecessor, Sakura Yoko KK, founded on April 6, 1951. So there was a predecessor. That's probably why there's a bit of a difference there. Okay, so the first thing I always look at when I'm researching a company is growth. Revenue growth over the last 3, 5, 10 years. I'm really focusing on 5 and 10 years. Now, over the last 5 and 10 years, nice growth, really above 15%. But over the last 3 years, the revenue growth has sort of subsided, only 6.7% over the last 3 years. So that could be a slight red flag. And the same can be said for earnings per share. Nicely growing over the last 5 and 10 years, in fact, above 20%. Over the last 3 years, only at 8.2%. So maybe this company is becoming a little bit more mature. Or maybe it's just a little bit of a dip before the next growth spurt. Now, I don't typically look at dividends, but dividend yield is 2.2%, dividend payout ratio 50.7%. I like that to be a little bit lower, but that's okay. And pretty nice growth in dividends as well over the last 5 and 10 years at about 25 to 30%. Okay, the other thing I should look at and always look at is margins. I prefer to look at 5-year history in margins, but on the overview site on Fiscal AI, it just gives you the last year. But gross margins at 46.8%, operating margins 27.9%. I wouldn't have expected that to have decreased or increased a significant amount over the last 5 years. So that's pretty nice. That's exactly what I want to see it. Return on invested capital, 29.5% over the last 5 years, 2 thumbs up, and return on equity at 30.7%, 2 thumbs up. So those are quality metrics are pretty high. And I do refer to return equity, return invested capital as quality metrics, although in Fiscal AI, they refer to them as capital efficiency metrics. P ratio 18.3. Okay, a little bit of increase of interest in this company based off that P ratio. So if this company had pretty good growth over the last 3 years, I think I'd be even more interested with a company on that sort of PE ratio. Now, there could be a reason behind it, so we want to delve a little bit more deeply. Maybe there was a one-off in earnings, which pushed their earnings up in the last year, which means the PE ratio is unusually low, but we'll have a look at that in a second. And the forward-looking PE ratio is at 20.5. So the market is expecting some negative growth, it looks like, based off that. A little bit of debt, but not too much. Okay, so I want to see what the bears say. And straight away, the first bear bullet point, this company faces strong competition from Applied Materials and Lam Research, two companies I do know a little bit about in its core areas and will lose market share if it were to fall behind technologically. If AI adoption fails, there will be no growth driver for the semiconductor industry. I don't think AI adoption is going to fail. And the company operates in the extremely volatile semiconductor equipment industry. Yep, that's probably true. The bulls also say Tokyo Electron gains more market share along with adoption of cutting-edge technologies. Products such as EUV and HBM, hyperscalers continue to invest aggressively, and high growth in generative AI service continues. Demand for advanced semiconductors will rocket as AI-enabled PCs and smartphones become more widespread than expected. Yes, okay. So let's just have a look at the financial history. Okay, so let's have a look at revenue. We'll have a look at income and also operating and gross profit margins. And we'll firstly focus on revenue and profit growth. Okay, so we already know that revenue and profit growth may have slowed down the last 3 years, but what I'll do is get rid of the last 12 months. So we just have the last financial year there. And there was a bit of a dip in 2024. There was a bit of a dip. So that's probably one of the reasons why this company has struggled to grow. Not struggled, but we haven't seen that above 10% growth in revenue and earnings per share because of a dip in 2024. But we also saw a bit of a dip in 2020. So that just shows you there is a bit of volatility when it comes to these type of companies. But typically that volatility only lasts 1 year. But over time, the trend is there. The trend is evident. In fact, over the last 10 years, revenue has not quite quadrupled, but it's getting there. And the company has shown some scale because profit has gone up eightfold, almost eightfold. So revenue gone up fourfold, profit gone up eightfold, and that would be, or could be an indication of some scale. Okay, that's nice. Now onto margins. So no red flags when it comes to those two, revenue and profit. Now to margins. I'm going to look at these individually. Okay. I want to look at gross profit margins first, and this is exactly what you want to see. In fact, when you see gross profit margins increasing like we have seen or are seeing with this company from 40% to 47%, that's not an indication of any competitive pressures just yet. The most important word there is just yet. But if you do see gross profit starting to drop, that could be an indication that there could be some pressures there, competitive pressures. Next thing I want to look at is operating margins. Now, we already know that margins have increased over the last 10 years because how profit has grown at a significantly greater rate than revenue. And one of the ways to do that is growing your operating margins or your gross profit margins. And we definitely see that. In fact, operating margins have gone from 17.6% up to 28.7%. Now, not up in a straight line, but there's definitely a trend there. Okay, next thing I'd like to look at, I'll just have a quick look at cash flow. Cash flow from operations. I don't think there's going to be anything untoward here. Nah, there's nothing untoward. A bit of a dip in 2021 and then back to growth. So that little bit of a dip in 2021, it's going to be interesting to see if the share price did pull back a fair bit because of fear in the market. But since then, nice growth in both operating and cash flow. Yeah, I was going to say something else there, but there was nothing after cash flow. Okay, now we'll have a look at return on equity and return on invested capital. So there might be a little bit of a dip in 2021. That's what I'm thinking. No, not really. In fact, these two have been consistently above, we'll say 20% since 2017. 2016, they were below 20%, but since then, exactly what you want to see, between 20% and about 40%. So there's no argument from me, and you could not argue just by looking at this company is not high quality, but we already knew that, didn't we? Okay, so nothing really, no red flags there. Now on to valuation. So I was thinking 18 looks pretty low for this type of company that is growing, but is that unusual? So what I'm going to do is have a look at P ratio. We'll also have a look at free cash flow yield, EV to EBIT, and EV to free cash flow. And we'll have a look at these one at a time. First one is P ratio. All right, so no, in fact, what I'm going to do is we'll have a look at the last 12 months. Here we go. So it goes up to right now. So P ratio like 18, and it's not unusual for this company. In fact, we saw the P ratio drop all the way down to 12 back in 2022. So that was a period of multiple contraction, and more than likely, we probably saw the share price drop a fair bit. In fact, just by looking at this company does go through cycles. In fact, the cycles are fairly short term. And back before 2018, it's fairly weird. But anyway, it goes up and down. Right now at about 18, you could say it's near being called cheap at a P ratio below 20. But we can see possibly fairly soon a period of multiple expansion. And the P ratio of this company could get as high as, say, 40, 50. That was a peak back a few years ago, which means if the company grows financially, you could take advantage of financial expansion plus multiple expansions. So possibly this company is looking interesting in terms of valuation right now, just based off P ratio. Look at the free cash flow yield. I'm expecting this to be on the low side as well. Yep, it's on the low side. Actually, what we're looking for here is a higher number. So I got a little bit confused there for a second. What we're looking for here is a high number. Yeah, it's been oscillating between 2 and 5% over the last few years. And before that, it was fairly weird. This should, free cash flow yield, this should go up and down every single day. Okay, EV to EBIT. I shall go to EV to free cash flow first. Oh, we have a bit of a dip there, big dip in 2021. And that must have been called a free cash flow. Okay, EV to EBIT. Last one I'm going to look at. Hopefully this is similar to, yeah, it looks similar to P ratio. So it's on the low side. So I definitely don't think this company is expensive, but I thought maybe P ratio of about 18 or EV to EBIT of about 14 would be historically low for this company. That is not true. That is not true. Okay, so let's have a little chart for Tokyo Electron. This is the weekly chart. And let's go all the way back. Now, prior to about 2014, this is not a chart of a high-quality company. Not at all. In fact, from when they listed 2001 through to about 2016, 17, share price did absolutely nothing, and then the share price went on a run. And since then, the share price, or the 200-week moving average, has acted as support. And yeah, it's been a pretty good indicator to when maybe buy shares in this company. So we did see the share price drop below the 200-week moving average in late 2018. We know why then. Looks like it bounced off in June 2019. Bounced off during the COVID-19 financial panic. Bounced off it, got very close to bouncing. Actually, no, it fell below and then bounced fairly quickly. Back in October 2022, we all know why. And recently, the share price has pulled back a fair bit. In fact, the share price has almost halved from the peak of 40,000 yen down to 20,000 yen. And the share price initially did immediately bounce off the 200-week moving average, but the bounce wasn't that strong. And now it's touched that level again. So based off this, and if you believe Tokyo Electron is a high-quality company with potential growth in the future, some pretty good growth in the future, now could be a good time to buy some shares in this company based off this chart and even based off the valuation, the P ratio and EV to EBIT. Now, by the way, I'm recording this video on the 18th of August, so this could have changed a fair bit. Okay, so that's all I have for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.